An index at record highs looks gorgeous, but is the whole market really marching? Tonight, over a good dram, we'll pop the hood and check the engine. Welcome back to True North Market Pulse, where numbers meet lifestyle. Pour a glass, spark a cigar, and let's learn. 70% of tonight is pure education on market breadth. How many stocks are moving, not just how far the headline index moves. Lesson 1, and it's the easiest breadth check you can run. On the right side of the laptop, you're looking at two price charts, same 3-month window. White line, SPY, the cap-weighted S&P 500 you see on CNBC. Red line, RSP, the equal weight version where every stock, from Apple down to the smallest component, counts the same 0.2%. Here's what matters. When the red line is climbing side by side with the white one, bulls are rowing in synchrony. But the spread you see here, white ripping higher while red rolls over, tells a different story. Translation: mega caps, Apple, Microsoft, Broadcom, are doing all the bench pressing while 400-plus stocks are catching their breath. A simple rule of thumb I keep taped to the base of my monitor. If RSP lags SPY by more than 3% over a month, tighten stops and cut position size in growth names. It's that basic, but it has saved me from more blow-ups than any paid newsletter ever has. Every trading day, it adds +1 for each stock that closes higher, and 1 for each that closes lower, then stacks those numbers into a running total. The yellow curve on your screen is that running total. Below it, the white index line is price. Focus on the yellow. It's trending lower, meaning more losers than winners, while price, perversely, levitates. That's a breadth divergence. Stat guys at Ned Davis and Bespoke have back-tested this pattern. When price makes a 20-day high with the AD line making a 20-day low, forward 2-month returns drop from plus 1.8% median to negative 0.6%. I don't short an index just because I see it, but I do 3 things instantly. Raise trailing stops from 8% to about 6% on momentum names. Switch new buys to half positions until breadth heals. Sell covered calls out 2 strikes on anything stretched. Get paid while the market decides whether to catch up or crack. Divergences don't nail tops to the hour, but like dark clouds on a horizon, they tell you to fold the deck chair and pull on a raincoat. Lesson 3. The 52-week high-low ratio, my favorite heartbeat monitor. Green bar, percentage of stocks printing new 52-week highs today. Red bar, percentage hitting new 52-week lows. The magic levels are plus 20%. Above plus 20% highs, you're in a confirmed breakout. Odds favor momentum trades. Think 9-month win rate of 74%. Below 20% lows, you're flirting with an internal bear market, even if the index hasn't dropped a dime. Right now we're hugging the zero line. Only 6% new highs but 5% new lows. Market indecision in one snapshot. Practical takeaway. When the red crosses 20%, I go full defense. Shift new capital into short-duration T-bills, low-vol ETFs, and quality dividend payers. When the green crosses 20%, I scale back in with risk-on ETFs, longer-dated call spreads, and small-cap screens. One stat for the notepad. Since 1990, buying the S&P 2 days after the green bar first breaks 20%, and holding for 6 months beat buy and hold 68% of the time. Lesson 4. The sector rotation compass. You've seen a wheel on my screen with 4 quadrants. Early cyclical, transports, semis, lead at bear market bottoms. Early defensive, healthcare, staples. Kick in when growth slows, but the Fed's still friendly. Late cyclical, energy, materials. Last gasp of an expansion. Late defensive, utilities, consumer staples on steroids, where money hides before full-on risk-off. The arrow tonight sits in early defensive. Translation: Institutions are quietly rotating out of beta and into balance sheet safety. Action plan. Screen for relative strength breakouts inside healthcare. UNH, LLY, JNJ. Trim overweight tech. Doesn't mean dump, just harvest partial gains. Watch credit spreads. If BBB corporate yields start climbing while utilities push higher, expect volatility to follow. Print this wheel, tape it next to your month-end statement, and ask, which quadrant is gaining steam, and does my portfolio agree? When they align, you'll stay one chess move ahead of passive index money. Screenshot this 4-point breadth checklist, grab the free PDF, and run it weekly. 5 minutes that can save you 5 years of regret. Yes, the S&P printed another record, but equal weight and AD are bending south. Green headline, amber dashboard. Headlines to watch this week. Alphabet blows out earnings. Asia rallies on trade hopes. Aussie dollar at an 8-year high. Full scroll below. Pause if you need details. Now let's move on to our top AI picks for the week. Broadcom. From custom AI networking chips to Google's TPU supply and the VMware merger, AVGO's pipelines are gushing cash. Palantir. Gotham rules defense data. Foundry is storming corporate boardrooms. Commercial AI revenue just doubled year on year. UiPath. The leader in AI-driven process automation just guided higher for fiscal 2025 and keeps expanding its developer ecosystem. Track what's under the market, not just the shine on top. If this helped, hit subscribe, grab the checklist, and comment breadth with a ticker you're watching. Stay focused, build slow, move true north.